Hey there, everyone. Today on the final bar, the S&P 500, further distribution for those major averages. The S&P back below 4,500 at the close today. Amazon surprises to the upside on a strong earnings quarter, but downside surprise for technology stocks like Apple, Palo Alto, and others as they struggle through earnings. The final bar mailbag will be reopened, including questions on Bollinger Bands and on-balance volume. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar on this Friday afternoon. I'm your host, Dave Keller. I'm the Chief Market Strategist at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the StockCharts platform. Our platform was designed about 25 years ago to empower online investors to make better decisions using technical analysis. The markets have evolved. The market structure has evolved. The market participants has evolved. The way that stocks trade has certainly evolved in the last 25 years, but the value of technical analysis, I would argue, is more important now than ever because it helps you cut through the noise and focus on price, focus on action in the markets. What better time to have that sort of reminder than a week like this? We've had all sorts of impactive news flow this week. Fitch downgrading the U.S. earlier this week. A lot of earnings, including Apple and Amazon on Thursday. A lot of catalysts pushing prices higher or lower. Macroeconomic data, geopolitical data. Washington and Oregon potentially joining the Big Ten. It's been havoc with news flow. At the end of the day, price is price, and focusing on the supply and demand, the fear and the greed as reflected by price action is what's most important. With that in mind, let's get to our Wrap the Week segment and focus on what we learned through the course of this week using all of the charts. But first, I want to answer a poll question. As a reminder, on our social media accounts on Twitter and elsewhere, we have our polls going. Also on our YouTube channel, just make sure you subscribe and check out the community portion. You'll see polls like this. Which sector do you think performs better over the next 3 months? This is a simple offense over defense kind of question. Offense in the form of consumer discretionary or defense in the form of consumer staples. 2-to-1 ratio. You guys are voting defense over offense. I would tend to agree. And what's interesting is this is the answer we got as Amazon actually beats earnings and gaps higher, pushing the XLY to the top of the leaderboard on today. But if you look over time, one of the charts that I have in my Mindful Investor Live chart list is what I call offense over defense. We've referred to this chart many times, but what this essentially does is it compares things you want over things you need. When conditions are good, when the markets are positive, when things are bullish and consumers feel pretty happy about things, they tend to make discretionary purchases like a new car, like travel and tourism, hotels, housing, all of those sorts of things are things you do when you have capital to deploy. When things get a little squirrely, you're probably not buying a new watch or going on a crazy vacation, but you're still buying household goods and cleaning products and alcohol and tobacco and those sorts of things. So offense over defense using these two sectors can be a really interesting way of seeing, essentially gauging what the mindset of the consumer is and how that's reflected in the prices of those sectors. Overall, it's been trending more offense over defense, but if you look at the month of July, a potential inflection point there about midway through. Strong in the first couple weeks of July, actually going weaker the last couple weeks. You can see that Amazon jumping higher today is pushing the XLY up. But if you look on an equal weighted basis, still sort of looking like a downtick over the last couple weeks. I would argue this is one of the more important charts to follow through the month of August. If you buy into that tactical pullback sort of thesis, which I would 100% agree with, had a couple good conversations about that, but the one with Ari Wald, I think on Tuesday, was a really good one, thinking about the short term versus the long term, the weakness that we see in the short term, but how that could set us up for further long-term gains. I think it's a really good way to think about this market right here in August into September. This ratio and looking at the XLY over the XLP, or the equal-weighted versions, maybe even better, could be a good way to do that. I would agree with the defensive tilt in our poll. I would say staples over discretionary. That remains to be seen. We'll see what happens. Let's keep on going with our market recap today, the Wrap the Week segment. Look at how the markets played out. So it was an interesting day, and I think if you're bullish, a day like today probably did not feel particularly good because the first half of the day was pretty strong. Going into the lunchtime hour, sort of a nice continuation, nice gap higher and push to the upside. But the afternoon was all about distribution. By the end of the day, we'd gone back just below the open, continued below 4,500. For the S&P closing around 44.78. That's down about 0.5%. So, not an end of the world kind of day, but days like today that open strong but finish weak tell me a lot. I think should tell you a lot about the mindset of investors and people willing to sell on those initial gains. When the market rallied this morning, people weren't piling in and pushing stocks like Amazon higher. They were actually dragging them down. If you look at Amazon, it actually finished with a kind of bearish candle pattern. We'll get to that later in the show. The Nasdaq Composite down as well, but not as much as the S&P. That was really the worst performer of the group. Mid caps and small caps, interestingly, were flat for the day. So while the S&P was down 0.5%, mid caps and small caps were kind of flat. Might be an interesting one to look at. Again, a lot of times that has to do with the sector distribution. Technology was down the most on Apple and others. PANW, I mentioned some of the other names. Fortinet, FTNT down pretty big as well. Those names coming down is going to hurt large caps a lot more than mid caps and small caps. They're a little lighter on technology stocks, so that's probably what you're seeing there. The VIX really continuing to push higher. That has been a really good conversation we've been focused on over the last couple of months, right? The low volatility environment we've been experiencing in 2023 really changing in the last week or two with volatility spiking. My conversation yesterday with Jeff Hughes talked a lot about a spike in the VIX, rotation lower in the skew, and that sort of way. It was an interesting conversation about the options market. If you're unfamiliar with that area and what things like the VIX and the skew really measure and the implications of a rotation, I would watch that interview with Jeff Hughes. It was actually really thoughtful, really well done by Jeff. Let's keep looking at the other asset classes here very quickly. Bond markets actually rallying today. Bond yields coming down today. We talked about 10-year yields on yesterday's show. We talked about the upside potential and what a rising rate environment means for growth stocks versus value stocks. And while I would say a rising rate environment is still sort of medium-term, long-term where we're at today, rates coming back down. 10-year yields still remaining above 4%. 5, 10, and 30-year points still remaining above there, and the 30-year yield still above 4.2%, but all those coming down a little bit from yesterday. Bond prices, of course, rallying. This is after the TLT broke down to a new low for the year. We addressed that on yesterday's show as well. Bouncing back up a little bit today, about 1.8% higher. Dollar index down by about 0.5% today. Looking at the commodity space, DBC, which is a broad commodity ETF, up 0.2%. Gold and silver up as well, but not a huge update. Copper prices down a bit, but not by much. Wasn't a huge movement kind of day for the commodity space. More sort of choppy sideways than anything. But I would keep an eye on things like crude oil, natural gas. That rise in energy prices has certainly fueled some optimism for energy stocks, the XLE, and going into this weekend, when you think about what sort of rotations we've experienced, I would say an influx of interest in energy is one of the bigger shifts that I've seen here recently. Finally, cryptocurrencies. You can see a little preview chart of Bitcoin really rolling over here as the equity sessions sort of continued on through the afternoon. Bitcoin and Ethereum and others sort of rotated to the downside. Not much of a down day, though. Bitcoin's still above 29,000. That's down about 0.6%. Ether prices just above 1830. In terms of sector movements, this was the XLY up and everything else down, and this was really, I think, more than anything, Amazon, one of the biggest companies in the U.S. markets, but certainly dominating the XLY. One of the largest names up there with like Tesla and Home Depot are sort of the mega cap heavyweights in consumer discretionary. Amazon up pretty good on earnings, which was pretty. And it was interesting. Yesterday, you had that upswing in Amazon. At the same time, you had a downswing in Apple, really diverging the two of them with very similar technical setups up until yesterday, really. And now all of a sudden, really having a very different contour to the chart. We'll look at each of those individually here in a minute. The XLY was really the only sector up big today, up about 1.5%. Again, that's dominated by Amazon's earnings win. Energy flat for the day, followed by communication services. A lot of sectors down today, and that's really the story of the markets through the course of Friday's session here. The XLK leading the way lower, down 1.4%. Utilities, which tends to be a fairly defensive sector, was down 1.2%. Consumer staples and real estate, both down about 1% for the day. Let's go to what we call the Wrap the Week chart. This is looking at returns in some major ETFs from last Friday to this Friday. So we start the clock on Friday, July 28th. We now look to where we're at today on Friday, August 4th. What happened through these major markets? So stocks not having a great week, as I'm sure you know if you've been following the show and following the price action through the course of the week. The S&P actually finished down 2.2%. This is one of the worst weeks we've seen in 2023. Certainly, I think adding further fuel to the idea that we're in a tactical pullback, similar to what we saw like in February and March and previous pullbacks, which we've not had many of. As Jay Woods, who was my guest on Wednesday, came to us from the floor of the New York Stock Exchange, which was a lot of fun. Always a pleasure to talk with Jay, who's just a super nice guy and a very knowledgeable and thoughtful trader and strategist. He was talking about sort of this distribution and what sort of rotation we've seen, looking at the pullbacks. And an average year usually has 2 to 3 pretty good pullbacks. Even in a really bullish year, you usually have a couple meaningful drawdowns. This is kind of the sense that I think we're getting with this current environment. A lot of my conversations this week really fixated on that reality. So the S&P down 2.2% today, or excuse me, this week. Everything, the other things I'm going to mention here, underperformed stocks or the large cap benchmark through the course of the week. Here's the Nasdaq 100 down 3%. So a pretty big down week for the QQQ. In red is bond prices. Even though bond prices came up today as rates came down, still down about 3% for the week, similar to the tech heavy Nasdaq. And here we have emerging markets down 3.3%. Everything else that I'm about to tell you about outperformed the S&P this week. In purple, we have the Russell 2000 down 1.1%. In blue, this is Bitcoin and gold, both down about 1% for the week, so outperforming the S&P. The dollar was up 0.4%. That's the UUP ETF that we like to track. And then in brown, crude oil prices performing the best out of this group. The USO, the crude oil ETF, was up 2.4%. I wanted to briefly just look at a couple other charts here to wrap up our Wrap the Week segment. I want to look at volatility. And what's interesting is as you look at the VIX, one of the things we've talked about in a low volatility environment, in some cases, it's pretty easy because all you're looking for is something to change, right? When volatility is pretty low, we have the VIX down at a 13 handle, meaning it's 13 point something. You're looking for a spike in volatility because, as the market continues to go higher, as investors continue to press their bets to the long side, investors don't tend to get more anxious and tend to get more panicky and have a spike in volatility. The volatility reading only starts to spike when investors get a little jittery and they start to take profits, and that initial rollover can cause a feedback loop. And when people see those initial losses, they panic and sell, and that causes additional losses. And that's how markets rotate lower very quickly. And that's why the way down is usually way more sudden and severe than a steady incline on the way up. Or as I mentioned many times, the markets go up the escalator and down the elevator. And that's kind of what we're seeing here. So I think we have seen that spike in the VIX that we've been waiting for. The volatility reading here above 17 going into the weekend. It was down at 13 and change at the end of July. So we've really seen a rotation higher in volatility. Now, there's a lot of room for the VIX to go much higher. Don't get me wrong. We're still at a relatively low level. But again, one of the warning signs we look for when the market's going higher on low volatility is a spike in the VIX. And I think this week, we've now seen that for the first time in a couple months. I think that's important to note. All right, let's look at some individual stocks. I mentioned Apple having a pretty tough day here. We mentioned on the show yesterday, they were reporting right after the close. We're sort of looking at the initial movements in the after hours trading. Now we can see what happened through the course of the day today. Apple gapping lower, of course, down about 4.8% going into the close. It closed at the lower end of the range for the day, which is usually kind of interesting. A stock like this, when it gaps lower, but you see buyers come in, you'll have a lower open, but then you'll move higher into the close. And that can often be a really encouraging sign because what that tells you is there's an initial downside reaction, but then when people really start to process it, they think, wow, Apple at a discount of 5%, pretty good, I might want to buy into that. That didn't happen here, and selling actually continued through the course of the day, which shows you after investors had a chance to digest what Apple was saying, they sort of decided as a group it wasn't worth taking additional positions now. Is actually more a better approach to lighten up. So gapping below the 50-day moving average. One of my YouTube videos on my channel called Market Misbehavior that I did a couple days ago was talking about these growth leadership names pulling back to their 50-day moving average and whether or not they would hold. For now, Apple not holding. And this is after Microsoft, another technology name, also did not hold its 50-day. Now, it bounced a little bit today, up about 1/3%, but really rotated lower through the course of the day. And I would say still the fact that these big mega cap technology names. Those two names make up about 50% of the technology sector ETF, the XLK. So the fact that both of them are gapping below their 50-day moving average and not recovering yet, not a great sign for technology, and I would argue not a great sign for our tech heavy growth-oriented benchmarks. Now, it wasn't just about Apple when you look at the technology sector. Some other charts look even more abysmal, and I'll show you a couple of them here. Fortinet, FTNT, down 25% today. And again, when people send me a chart like this and say, what do you do now? I mean, the answer is, it's tough. You have to reassess, of course, and you have to look, where we're at right now, what we call the final bar, look to the left, see where we're at relative to where we've been. And my general comment on something like this is the reality. If you invest in individual stocks, you have to be prepared that any one of those names could gap down 25% at any given point. The question you should be asking yourself now is, would you put new money into a stock like this, which is now down another 25%, right? To be honest with you, if you had your stop up here somewhere, your stop's been triggered, and I would argue more often than not, the best answer when a stop is triggered is to get out and not debate whether or not the stop really made sense or whether I want to pay attention to it right now. That's where you are opening yourself up to all sorts of bad behavioral biases that we really try desperately to avoid in the normal course of our investment process. So I would be using things like Fibonacci retracements and sort of identifying some potential support levels. But the fact that we've gapped down, we're now into this price gap from February is maybe the only redeeming quality I can see on this chart is, what's the likelihood that we continue below 54? And maybe that's sort of that downside range to think about, buying in on the dips. But overall, I think the damage has really been done with a chart like this, gapping down 25%. I would be inclined to be looking for better opportunities elsewhere and take your capital to greener pastures. Palo Alto Networks, PANW, another technology name gapping lower. This is really the story of the end of this week, is big tech names struggling with downside earnings gaps. What's interesting about PANW is testing support. As of yesterday's close, right at the 50-day moving average, we're testing the swing low from early July. All of a sudden, seemed like this could be a potential floor not to be had. And again, the problem I have with a chart like this going forward is there's a lot of damage, technical damage that's been done. Here's a trend line connecting the January low and the May low. You can see we've now gapped right below that trend line. So, why would I be taking a position in a chart like this when I could be taking a position in a chart that looks much more actionable from a technical perspective? For me as a chartist, that's more likely where I'm going to want to go. Now, it's not all bad to finish our market recap. Charts like Amazon gapping higher. Amazon up 8.3% by the end of the day. It did go higher, and it actually closed at the lows of the day, and I think that might be an important fact to remember when we open trading on Monday morning. We are finishing this week in a position of weakness, and the negative earnings from the technology space is dragging things like Amazon down. If things are good, a company beating earnings with a good outlook should gap higher and continue to go up as additional buyers are willing to pay more and more. That's not what we saw here. People were actually selling the gap higher on Amazon. Other names gapping up as well, so I would encourage you to use our scan engine to try to find some of those actionable opportunities. We've got to close that segment up here and go on to the final bar mailbag. Before we get there, though, I'd like to make a couple quick announcements. Our mailbag is fueled by questions, and those questions come from people like you. As you are analyzing your own charts, as you're using the Stock Charts platform, as you're trying to make sense of these markets in uncertain times, what questions are you running into? Let us know. The final bar at stockcharts.com is the best way to get your questions to us. On Twitter, just tag us in a comment at finalbarsctv. And on our YouTube channel, of course, just drop a comment below the video that you're watching. We'd love to hear from you. We'll hope to answer your question in our next mailbag segment, which will be on Monday's show. Also, as a reminder, I will be speaking at the Money Show in Las Vegas next week. I'll be going down there on Monday after this show, and then I'll be presenting twice. Once on Tuesday, a quick 30-minute segment talking about the top 10 charts I will be watching between now and year-end 2023. On Wednesday, I'll be doing a 2-hour premium masterclass where I'll share with you the technical analysis checklist that I use when I'm analyzing a chart for the first time. You can sign up for both of those sessions and many more from Larry Williams, Tom DeMark, who else? John Bollinger. The list is fantastic. A really good group of speakers at stockcharts.com/moneyshow. Let us open the final bar mailbag, see what sort of questions has come through here recently. These are all questions we've gotten from you guys in the last couple days and in the last couple weeks. Question number 1. Dave, is it bullish or bearish when price is above the upper Bollinger Band? And I love that question because it actually, that could be an entire 2-hour masterclass, to be honest, if not more. And I'd love to see John Bollinger answer a question like this because he could, I mean, really talk to you about a lot of the nuances. We rarely can get into that sort of depth on the final bar, but it's a really good question. That question actually came from the fact that on our predefined scans, I think is where you mentioned you look at it. If we go to the predefined scans here, you can see under technical indicators, let's see, moved above upper Bollinger Band is listed under the bullish technical indicators. And your thought was, I thought if it gapped above or went above the upper Bollinger Band, isn't that bearish because it's sort of at an extreme move. Here's what you have to remember. Bollinger Bands can mean different things depending on your time frame. And I'm drawn back to my conversation I had with Ari Wald earlier this week. We were talking, and with a number of my guests, about the short-term perspective and the long-term perspective. I think we're seeing a lot of evidence suggesting a short-term pullback. And some of the strategists that I followed that have been correctly bullish, very much so in 2023, guys like Ari Wald, Tom Boley, and others. I was emailing with Tom earlier this morning talking about how he has turned tactically bearish because he sees the signs that there's a rotation. Now, there's a difference between a tactical pullback and a long-term trend. And both of those strategists I just mentioned, Ari, Tom, and others, are long-term bullish. They would see a pullback as an opportunity to ride the next leg higher, while other strategists are seeing further deterioration. So I think what you have to remember is your time frame. So I would say is when the price hits the upper Bollinger Band, that often can be a short-term tactical pullback, but usually means the structure is more positive. So it's sort of like a stock becoming initially overbought. It might tell you we might be due for a pullback, but that often can give you a really good entry point to ride the price higher. That's why we bucket a Bollinger break to the upside, a move above the upper Bollinger Band as under the bullish category, just because it's generally, for a medium-term, long-term investor, can often identify stocks that are rotating to more of a bullish phase. But if you're more of a swing trader, more thinking tactically, that's where I would use some of the other tools to identify maybe the optimal entry and exit point for that particular type of trade. So that's the answer to your question. Thanks so much for asking that. And again, I'd encourage you guys to explore the predefined scans. What's really helpful is you can actually run the scan. You can copy the details of the scan or actually import it right into our scan engine and then create your own custom scans as a result. So for example, if I'm looking at the moved above upper Bollinger Band scan, I can find some of the individual stocks that fit that and then just say edit scan criteria. That'll go into the advanced scanning engine and you can tweak that scan, incorporate other signals as well. Next question, Dave, how did you do the see-through red and green colors on your charts? And I appreciate that question so much. Anytime I show the McClellan oscillator chart that I created, I get a question along these lines, and I appreciate it very much. This is something that I was toying a while ago with just different ways I could take the stock charts platform and show things, right? And we've experimented with the development team looking at little icons and arrows and color coding the bars and color coding things because we are in the process of upgrading our Sharp Charts engine. That's our main charting engine that you're probably very familiar with. We have a new interface, a new UI that is very, very close to release. We also are rebuilding this entire platform from scratch. And one of our head developers is spearheading that effort. And what's really cool is we're getting in rooms and saying, all right, what would we want this to do, and how can we visualize things in ways we haven't done? And it's giving us a lot of cool capabilities that I think we'll be really experimenting with for years and years to come. Having said that, this is one of the charts we've looked at, just thinking about different ways we can color code signals and price action and make the charts more meaningful. And what I did with this chart is basically use the annotations to do it. This is more of an annotations trick than anything else. Below the Sharp chart, if you click on annotate, you get these guys. And if you take a rectangle, you can actually make a big shaded area like this. And then you can actually take the color and just make it more and more transparent. And all of a sudden you have this little shaded area that you're able to create. So what's funny is this is a really good way of showing, of highlighting a particular price range. So I actually use that technique to highlight, support and resistance levels. So I like to highlight them as ranges. So I sort of use that sort of, tool to highlight a particular range on a chart. It's also good for shading the whole area. You literally just make it as big as the chart itself, and you can color code the whole background. So it's a fairly manual process. Some of the things we're looking at are ways to automate that and make it a little easier for you to shade your charts based on different simple comparisons that you can make. So a lot more to come, but that is the way that I did that chart. And I should fully credit Arthur Hill. He showed me years ago tricks using the annotations tool. He showed me how to use the rectangle tools to do some really cool stuff. So thanks again, Art, for giving me some really good ideas of how to use the charts a little better. Next question. When we see heavy downside on balance volume while the Chaikin Money Flow is green, is it generally bullish? Sorry, I went full acronym on that question, didn't spell those out, but OBV meaning on balance volume, that's a Joe Granville designed indicator as a way to understand volume over time. CMF is Chaikin Money Flow, Mark Chaikin's, I would argue, improvement on balance volume. I have a chart available to show you here. Here we go. So this is an adaptation of the chart that you sent in, the person that sent in that question, and thanks so much for that. Your comment was, heavy selling into year-end 2022, money flow, Chaikin Money Flow shows accumulation is bullish, and I would agree. And what on balance, just to make it clear, what on balance volume is doing is every day, if it's a down day in price, that volume, that day's volume is considered down volume. So the on balance volume goes down that volume amount. If it's an up close, you add that day's volume to the running total. And so the on balance volume is literally looking at the trend in volume over time. The problem is it's doing it a very simplistic way. Did the stock trade up or down? So if it went up, 0.0001%, that entire day's volume is considered bullish volume. So what Mark Chaikin has done is made some improvements. Accumulation distribution is one of those indicators. Chaikin Money Flow is another one. And what it basically is doing, boy, this is a horrible way. It's doing a stochastics volume is the way I would describe it. It looks at where we close versus the high and the low for the day, and the volume is weighted based on where the close was in that range. So if we close more toward the upper range, that's more bullish volume as opposed to bearish volume. If we close at the lows of the day, it's more bearish volume and less bullish volume. So it's really an interesting way of measuring it, but it doesn't adjust for price gaps, which is why you can get some different looks between on-balance volume and Chaikin Money Flow. So I would agree with you, sort of going into the end of last year, Chaikin Money Flow turning bullish on a stock like Salesforce really suggested that there was accumulation happening during the day, right? We were closing up through the course of the day, and that implied institutions accumulating some shares here. What's happened more recently is the on-bounce volume is rotating lower while the Chaikin Money Flow is remaining positive, and I think that's a bit of a difference. Next question, is copper going higher, and is that bullish or bearish for stocks? Hard to summarize that in one answer, in one moment, but I'll do my best here. If we look at, if we look at my chart of copper, I'll tell you what's happening with copper. So generally speaking, copper is a good indicator of economic strength. The idea is when the economy is growing, and I'm summarizing here, I'm generalizing. When the economy is growing and we need to build more stuff, you need more copper, right? You need more raw materials. So copper prices going up usually means there's more demand for building things, and that usually means the economy is growing. When copper prices are going down, that means we don't need to build as much stuff, which means the economy is probably slowing down. We don't need to build new buildings and new houses and all that kind of stuff. So it is a very sort of general way of thinking about the strength in the economy. The reason why I think it's an interesting chart to look at now is because if you look at the chart of copper, we broke above resistance over the last couple weeks, and I would argue this is sort of an ascending triangle, I guess is the way I would probably label this, where you have a consistent resistance level and an inclining support level. So that's sort of a little triangle pattern. We broke above it, and this is actually when you sent the question, it was on this day where we got right to $4 for copper, but the next day was right back down. It ended up being a bearish engulfing pattern the immediate next day. I think that's pretty important to note because anytime you get a gap above resistance, it's all about the follow through. I always talk about, did we get a follow through immediately after? We did not in this case. So copper pushed up to $4, but came right back down. You didn't get that confirmation, that validation of the uptrend. So I would argue this is still a chart that is not broken out yet. I'd want to see a break above resistance, break to $4 would be great, but then following through the next time. If copper would go up, that would be great, a great sign for economic strength, but we're not really seeing that just yet. Final question here for the day. When trading LEAPS options, should we be using technical analysis on daily charts or weekly charts? LEAPS, if you're not familiar with it, are a sort of a long-term option. No, it stands for long-term equity anticipation securities. And what LEAPs are basically doing are they're options that expire down the road, right? So not just next month or 2 months out, but years down the road. And they were designed many moons ago as a way to give long-term investors an opportunity to use options, not be tied up in the time decay that you run into with short-term options, but really make more long-term bets. And it can often be a really interesting way of hedging a position. So I did a special recording earlier, and it was actually last week with or the week before, now that I think about it, with Jessica Inskip of Options Play. We looked at protective puts. And LEAPs can be an interesting way of using the options market for protection if you're concerned about a shift in the market and you want to lock in gains or minimize your downside risk. What charts you look at, I think that's a really interesting question. Depending on how far out you're looking, I think that would answer your question. So if you're looking at short-term options, a daily chart is probably sufficient. If you're looking years down the road, you better be looking at a chart that gives you a sense of years going back so that you can make a proper projection. So if you're looking at LEAPs, I would start with a weekly chart and then go from there, because that's going to tell you sort of the key levels and key patterns and key inputs that you want to be aware of if you're going to make a good decision on what strikes to use and what expiration to use and what sort of planning you want to do using LEAPs options or long-term options. That is our mailbag for today, guys. Thank you so much for those really thoughtful questions. We'll do another mailbag segment on Monday, so if you didn't get your question in, make sure you do it. But we have to wrap today's show and wrap this week with the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here, it's chart number 1. You know, talking about my market trend model, this is looking at the S&P 500 on 3 different time frames: long-term, medium-term, and short-term. Today, on Friday's close, is when I'm able to update the model. I don't update it through the course of the week, but when I lock it in on Friday, I like to confirm any changes. Today, short-term model actually turning bearish, and I waited to change the label to see if we get some sort of rally into the end of the day. We didn't get it. So the short-term model actually turning negative, and that's the first time it's been negative since February and March, the last meaningful pullback that we've had. So for now, it's starting to look a little bit more like the conditions we had in February, which was a fairly actionable pullback, sort of a 6-week drawdown. By the way, just to switch gears in ACP, Grayson Rose and I were talking about some different ways to use the multi-chart views on ACP, the multi-chart layout. So I actually created a view with the market trend model on different indexes. So this is the large caps, mid caps, small caps, and the QQQ. And if you look at the bottom, this is that short-term model that I mentioned. You'll notice for mid caps and small caps, it's still bullish, but for large caps and the Nasdaq 100, both turn negative as of today's close. So I think, again, that validates that sort of short-term bearish thesis we've been fleshing out through the course of this week. Chart number 2, Amazon. Pretty impressive to see charts like Amazon gapping higher. Don't get me wrong, an earnings beat is encouraging. That's always better than not. However, when you look at the activity in charts like Apple and Amazon, even though they had a different move today in terms of Amazon gapping higher, Apple gapping lower, look at what happened through the course of the day. Apple gapped down and then kept going lower. So there weren't any investors really, broadly speaking, jumping in or seeing that gap down in Apple and saying, perfect, I'm going to jump into this. For now, it was more selling into the close. Same kind of thing happened with Amazon. That created what's called a shooting star candle. It doesn't need to be a gap. It actually did get a pretty good gap today, of course, with Amazon opening around 141. Traded up to almost 144, but by the end of the day, trading back down toward the lows of the day. So very little lower shadow, a big upper shadow. It's called a shooting star candle. It's negative. Tells you the next 1 to 3 price bars most likely weaker than stronger. So both Apple and Amazon, I would argue, even though the movement was different from yesterday to today, going into next week, I think both of them setting up with more of a bearish short-term sentiment than a bullish one. Chart number 3, crude oil. This is looking at the $ WTIC, which is our crude oil continuous future that we track. By the way, we were doing some really good work with our data team to build out our coverage of options, which I'm sure you've seen. We've had a lot more options content and options-related discussions on Stock Charts TV. A lot more to come as we build out our footprint with the options market. Also with futures and commodities, that's the next level we're starting to look at. We're finalizing some improvements to our database to be able to handle things trading 24 hours and doing some different things. But overall, we should be able to announce that to you here very soon, I hope. If you look at the crude oil contract, you can see we're testing resistance from April based on this chart. Crude oil got above its 200-day moving average. That's the line in red. That's what did not happen in April. That's what has happened. We actually tested it in early July, pulled back, and then broke out. Now we're testing sort of that last level, which is the April high, right around $83 a barrel. If you see, if we break above there, I'm highlighting the Fibonacci framework. I took the high from June of last year and the low from March because I see this May low as sort of a retest of that March low. If we take that framework, first level of resistance, 38.2% level, should be right around $87. That's a little bit, about $5 above current levels. I think that might be a good short-term target if we do get a break here. But look at the relative performance of the energy sector. Energy has been underperforming for quite some time, but you're seeing an uptick because of higher crude oil prices. If you see crude oil going higher, you probably want to assume that energy, the XLE, will probably follow suit on a relative basis. Folks, that's a wrap for this show and a wrap for this week. Thank you so much for joining us every weekday after the close for the Final Bar. We had some really good conversations this week with 3 fantastic guests, so make sure you check out those interviews if you missed them. We'll be back all next week, but until then, have a fantastic weekend. We'll see you next week.